Joining us this morning is Goldman Sachs Managing Director, Head of Oil Research, Don Stuyven. Don, it's great to have you. Thanks for the time. It doesn't sound like you were necessarily moved by this demand data yesterday.
Thanks a lot, Carl and Sarah, for having me. So yeah, we believe that the crude sell-off reflects temporary factors, in particular unguided fears about gasoline demand, overdone fears about the rates-driven recession, and some technical factors. Because we think that these bearish factors will ultimately prove to be transitory, we think that OPEC, thanks to its elevated pricing power and robust demand, will push Brent to $100 per barrel by next spring. Yesterday's DOE data that showed a sharp drop in U.S. gasoline demand and a sharp rise in inventories for gasoline in the U.S. actually amplified a sharp sell-off in gasoline markets, gasoline refinery margins, which is then bleeding into the crude market. We think that these data significantly understate the robustness and underlying demand for gasoline and understate the underlying tightness in global inventory for gasoline.
Right. Then U.S. production and non-OPEC production, not enough to come to the rescue?
So we think that U.S. production is going to slow down significantly from rapid growth this year because of ongoing capital discipline. And then OPEC, we think, because it has such elevated pricing power and because the region needs a lot of money to fund its ambitious expansion projects, will be very patient in bringing barrels back to the market. We, for instance, think that the group level cut that was announced in the spring of last year will extend through 2024.
What's going on with the Strategic Petroleum Reserve in the U.S.? Last week, when prices were still spiking, I know they've come down a lot since then, that was all the talk of whether the administration would step in again ahead of the holidays. What is the situation with how much they've got left and how much wiggle room they have to do more?
So the significant releases of the SPR were a major contributor to the sell-off in crude markets in the second half of last year and the first half of this year. However, moving forward, we don't think that the SPR will be a major driver of crude prices. The main reason is that because you are down almost 300 million barrels over the last 2 years, the level of the SPR is low. And so the bar, we think, to start releasing barrels again is pretty elevated. So in our base case, you get only a very modest pace of refilling, less than 2 million barrels per month. But I think you need very significant price moves to sort of get off from the path where the SPR is not a game changer for crude prices.
Finally, Don, Putin is on the tape today talking about Ukraine. Obviously, funding very much in doubt in Washington. Can you just talk about where Russian supply, that geopolitic element might fit into the demand or supply picture?
So I think one key reason why crude prices rallied earlier this summer until a month ago is really that Russia has started to comply with the cuts agreed with the Saudis. When we look at our nowcasts of high-frequency Russian productions data, that continues to be the case. And so we believe that the Russians will continue to comply, cooperate with the Saudis, and that this will contribute to low supply and a deficit throughout next year.